Hello everyone and welcome again to my how-to education channel. As I promised you last week, today we're starting a new topic in finance. Financial statements, taxes and cash flow part 1. After watching this video, don't forget to leave me your feedback. The figure found in the upcoming slide is called a balance sheet. I got it from the following reference website. A balance sheet is a financial statement that depicts in numerical values how much of assets, liabilities, and equity a firm has at a particular point of time. If we look at it on the next page, we see that it dates to December 31, 2018. This means that on the 1st of January 2019, we might have more or less assets, thus implying more or less liability or equity. In other words, this balance sheet will not be valid anymore on the 1st of January 2019, just as it was not valid on the 30th of December 2018. I will be explaining throughout this lecture what are assets, what are liabilities, and what is owner's equity. Assets have to do with ownership. They are what the firm owns and what it invested on. Liabilities and owner's equity have to do with financing. These are the two ways that a firm has to pay for the assets. Using this logic, we can conclude that assets equal liabilities plus owner's equity. And this is what we call the accounting equation. Before we can move on to the next point, let's go over the concept of liquidity. An asset is said to be liquid if it can be converted to cash as quickly as possible, but without a significant loss in value. That is, let's just say that you suddenly fell into a large financial trap and need $900,000 as soon as possible. Let's also consider that you can sell your $1 million apartment to cover for that pitfall. Does that mean that your apartment is a liquid asset? The answer is no. Even though your apartment can be sold and converted to cash, it's highly unlikely that you will be able to sell it quickly without a significant loss in value. Any $1 million asset can be easily sold for $300,000, for example, but in that case, $700,000 were lost. If the apartment were sold quickly for $1 million, then we could have said that it's liquid since its value stayed the same. Sometimes a firm can be too liquid as well. This isn't an advantage either. In this case, too liquid means that it holds a lot of cash. Nevertheless, when holding a lot of unused cash in hand, you're losing the interest payments that you would get had you invested this cash. As you can see in the balance sheet at the beginning of this lecture, the assets are listed in order from the most liquid, which are cash or current assets, to the least liquid. The next slide shows another example of a balance sheet. Note that total liabilities equal $16,000. Total stockholders' equity equal $85,000. $16,000 plus $85,000 equals $101,000, which is the total assets. Thus, total assets are always equal total liabilities plus stockholders' equity, which is our accounting equation. Usually, as we have seen from the two previous balance sheets, on the left side of the balance sheet are the assets. Assets are classified as either current assets, which are the most liquid ones, such as cash, accounts receivable, inventory, or fixed assets, which are the least liquid ones. Total assets equal current assets plus fixed assets. Fixed assets are either tangible or intangible. Tangible assets are the physical assets that a firm owns, as for example the equipment, land, and building. Intangible assets do not exist in physical form, such as copyright laws, trademark, and patents that protect the firm. On the right side are the liabilities and the owner's equity. Just as we have current assets, we have current liabilities, which are usually accounts payable, notes payable, and short-term liabilities, and long-term liabilities. The current liabilities are the ones that must be paid within the next 12 months. Total liabilities equal current liabilities plus long-term liabilities. The net working capital is the difference between current assets and current liabilities, as in net working capital equals CA minus CL. If the net working capital is positive, we assume that within the next 12 months, the firm will always have more assets than liabilities, and therefore will not have any problem in paying its obligations. The net working capital increases if current assets increase or if current liabilities decrease. Buying something will usually decrease net working capital since cash goes out of the firm, whereas selling something will increase the net working capital since cash goes into the firm. If net working capital is zero, we assume that within the next 12 months, the firm will have the same amount of assets and liabilities, and therefore will not have any current asset left after paying its obligations. This is a rare case. If the net working capital is negative, we assume that within the next 12 months, the firm will always have more liabilities than assets, and therefore will not be able to pay its current obligations. The analysis of the balance sheet can give us a lot of information about how the firm is doing at a particular point in time, and the analysis of many balance sheets will give a lot of info about a particular period in time. There are three concepts to keep in mind when analyzing a balance sheet. Number 1, accounting liquidity. Number 2, debt versus equity. And number 3, value versus cost. The first concept was already thoroughly explained at the beginning of the chapter. The more liquid a firm's assets are, the more likely it is that the firm will be able to overcome any financial difficulty that might arise and to meet its financial obligations. Any firm needs an adequate amount of liquidity to keep functioning. Nevertheless, one must keep in mind that, as mentioned before, the more liquid an asset is, the less return in interest a firm can receive. Thus, a firm must know how to keep a good balance between a liquid and non-liquid assets so as to be able to deal with any financial difficulty without any losses to the value of assets. Note that cash is the most liquid of the current assets, followed by account receivable and then inventory, which is the least liquid of current assets. The debt versus equity concern is about deciding which combination of debt and equity to use when financing the assets of a firm, its capital structure. Of course, the creditors, which are the ones who lent money to the company, are the first one to claim a firm's cash in case it does not fulfill its payment obligations, and can even take legal actions against the firm in this case. Stockholders, on the other hand, will only receive their dividends after all the debt is paid. Thus, they have what we call a residual claim, which is what's left of it. When choosing debt over equity to finance the assets, one is using financial leverage. Lastly, the value versus cost concern. The values of the assets, liabilities, and equity in the balance sheet are called book values. Book value is the historical value minus any accumulated depreciation in case of land or building. Today, an asset could be worth more or less than its book value, which is the value that the firm paid for it. Nevertheless, the balance sheet will always keep its book value. Market value is the price at which the assets, liabilities, and equity could be bought from the market or paid for today. Current assets and current liabilities have very similar market value and book value, but this might not be the case with fixed assets, long-term liabilities, and equity. The financial manager's main goal is to increase shareholders' wealth. To do that, he or she has to increase the market value of the shares to the maximum. The market value equals the stock price times the number of shares. This next example will help you clarify this. Let's say a firm's book value is $1 million. This is the balance sheet value. If the company does a good job and the customers are satisfied, its reputation will increase and the firm's value will consequently increase too. This is the market value. A bad construction or road blockage close to the firm would decrease the market value. Liabilities are recorded at their face value, which is the value that needs to be paid without taking the interest into account. In other words, the book value. When the risk that the firm needs to take changes, the interest rates will respond to these risks, and thus the value of the liability will change too. This is the market value. Let's recap. We know that assets equal liability plus equity, and liability equal assets minus equity. Equity equals assets minus liability, but assets are current assets plus fixed assets, and liabilities are current liabilities plus long-term liabilities. So equity equal current assets plus fixed assets minus current liabilities minus long-term liabilities. But we know that net working capital equals current asset minus current liability. Thus, equity equal current assets plus fixed assets minus current liability minus long-term liability, which is equal to net working capital plus fixed assets minus long-term liabilities. The figure found in the upcoming slides is called an income statement. I got it from the following reference website. An income statement is a financial statement that depicts in numerical values the situation of the company over a period of time. And by situation, I mean revenues and expenses. An income statement can have many formats, but it usually starts with the revenues, and then all the expenses get subtracted to find the net income. The simplest definition of net income is the accounting definition. Net income equals revenues minus expenses. Nevertheless, an income statement uses a much more detailed equation to find the net income. A company's earnings before interest and taxes are deducted equal to the net sales minus cost of goods sold and other expenses minus depreciation. Once the interest paid is deducted from the earnings before interest and taxes, we will get the earning before taxes. Then, after taxes are deducted from the earning before taxes, we will get the net income. This net income either goes to pay dividends to the shareholders or as retained earnings. We know that net income equals dividend plus retained earnings. The following income statement added one more step. Sales revenue, which is considered as net sales in this case, minus cost of goods sold equals gross margin. Gross margin minus any selling, general, administrative, or depreciation expense equals to the operating earnings. Operating earnings are what we called the earnings before interest and taxes. So earnings before interest and taxes minus interest expense equals earnings before income tax. And the earnings before income tax minus the tax expense equals net income. From the equation before, we can conclude two other important measures of the net income: EPS and DPS. EPS, as in earnings per share, shows how much the company earns for each share that it issues. EPS equals net income over number of outstanding shares in the company. DPS, as in dividends per share, shows the total dividends that a firm pays in 12 months divided by the number of outstanding shares. So dividends divided by number of outstanding shares in the company. Cost of goods sold are the fixed and variable cost of creating the good that will be sold to generate revenue. Fixed costs are the costs that a company must incur, whether it sells the product or not, as for example rent, salaries, depreciation, water, and electricity. Variable costs are the costs incurred at the production stage, as for example material costs, production wages, and so on. We are going to start next week's session by solving the following problems. If I were you, I would take a look at each one of these problems and try to write down their solutions on a piece of paper so that we could check them together next week. This is it from finance for this week, but if you have reached the end of this video, it is because the content was helpful to you somehow. If this is the case, don't forget to give your friends and acquaintances the opportunity to have access to these videos by liking, sharing, commenting, and subscribing to this channel. We will be continuing with the answers to the problems plus taxes and cash flow next week. But before that, I will let you know on the weekend how I chose my university major. Thank you so much.